Good morning and welcome to the Killik podcast for Friday the 15th of April. So a huge week for corporate earnings next week. We're just going to touch on three: BHP Billiton, Goldman Sachs and Amazon. So good week for markets this week, primarily due to Chinese data stabilizing. We had a decent import and export number, and we had a GDP number this morning that was in line. So stocks that are exposed to China are heavily discounted in markets at the moment. So this increase in the economic surprise index, so improving macro data, is helping that sector. That leads us into miners. Have we seen the bottom for miners? So clearly the second half of last year was really tough for the sector and for commodities. So we saw a 20% fall in the commodities index, the black line here, and an even larger or geared effect on the metals and mining index, which fell 35% during that period. Since then, since January, we've seen a 20% increase in the commodities and a 50% increase in the stocks. So we go into the BHP results with quite a strong tailwind behind the share price, which we haven't been able to say for quite a long time. If we look at BHP, one of the reasons why people got so concerned about the stock was that the credit spread started to blow up. So the cost of their debt went up very aggressively into the end of last year. They took remedial action and we've cut the dividends, so they're now delivering a 50% payout, which is yielding around 3.4%, and that's covered at $30 per tonne iron ore. And they're also cutting capex back, so we've got an expectation of a further $5 billion of cut to capex. So what they're trying to do is rebuild their free cash flow and reduce their net debt, which has already got the cost of their debt down quite significantly. And that's what's happening across the mining sector as companies look to survive through restructuring. Oil's also had a really good rally off the lows, so we're around 58% off that January low and 17% up over the last couple of weeks. And that's in anticipation of an expected supply freeze that we should get from Doha this week. We also had JP Morgan results this week, which acts as a fantastic bellwether for the sector. So the read across were strong equity and fixed interest trading, which is good for Goldman Sachs, which report next week. We also had a positive read across for credit card spending, which was up 8% year on year, great for Visa in terms of that read across, and American Express. And they're positive on loan growth, albeit offset by slightly weaker credit. But that is symptomatic of a pretty healthy consumer in the States. So we've seen a really good rally in banks this week after some fairly subdued performance in that sector. So going back to the results, huge day, as I say, for results on Thursday, of which one of them will be Amazon after hours. We're expecting to continue to see a compound annual growth rate in e-commerce for Amazon of around 20%. And that across the existing fulfillment network is creating leverage. And as you can see here, we're starting to see some fairly significant outperformance on online versus the standard US retail index. So why is that? We think that the cycle is self-reinforcing, so we see accelerating growth, we get gross margin expansion. That margin is invested into product fulfillment improvement and improving customer service. That improves the experience, which drives more uptake and increases the Amazon Prime members. Prime members increase their basket size, they increase their recurring orders, and therefore you get further accelerating growth. So we've had this sort of virtuous circle that we think can continue into the next 3 or 4 years. So that's it from me. Thanks very much. Have a good weekend.